Hi, Jocelyn. Are we still admitting anybody from the lounge? I'll prefer to start on time.
Okay, sure. You may begin.
Okay, thank you. Okay, hi everyone. Just give me a minute to load the slide. Okay, hi everyone. Thank you for being on time. You're seeing me again, Jenny here. So, okay, today I'm not feeling too well, having cough, flu, and sore throat. So, if you will excuse me later on, I think when we start the lesson proper, I will just switch off my video lah. But today will be the same as what we have done for last week. There will be two 10-minute break, one at 10 to 10:10, the other one at 11:15 to 11:25. Okay, so as we go through the slides, you can raise any questions. You can unmute the mic. We'll also have poll questions along the way to check your understanding. And then at the end of the session, we will go through, when we see how much time we have, we'll go through like some of things I'll just highlight some of the points for you to look out for in the exams. Okay, so meanwhile, I also hope that you have your case study tool ready on hand so that anytime I may just refer to them. Okay, so I'm going to switch off my video now and we will go through the lesson. Yeah, thanks for understanding. Okay, so last week we stopped at the part on deductible expenses. This week we'll continue with non-deductible expenses. Non-deductible expenses is actually a specific provision under Section 15. Okay, and it's saying that here it says no deduction is allowed in respect of ... Okay, so we'll go through some of the more common ones under Section 15 of the specific deductions. Okay, so under Section 15(1)(a), we have domestic or private expenses. So domestic refers to home or household affairs. Private refers to expenses incurred other than in connection with earning of the income of one's profession or business. So one example is if you're an employee, you're traveling to and from the place of your employment and your home, for example. So this will be regarded as a private expense. It can be very wide. So it's actually anything that's not actually related to your business also. Moving on, we have Section 15(1)(b). Okay, so for 15(1)(b), if you recall, we said that expenses to be deductible under 14(1)(a) should be wholly and exclusively incurred in the production of income. So 15(1)(b), it says expenses are not deductible if they are not wholly and exclusively incurred for acquiring the income. So in a sense, it reinforces the requirements of the general deduction rules under Section 14(1). Then it's not applicable to any expenditure qualifying for deduction under certain specific deduction provisions. So again, under 15.2, there may be certain things which may be like capital or something, but we allow a deduction. Okay. Then moving on, we have 15.1c, capital expenditure and capital losses. This refers to amounts that are expended to acquire items of capital nature. Example quoted here, for example, a purchase where you bought over some company, may have a goodwill component inside, or when you set up the company, you will need to incur incorporation expenses. So, for example, the incorporation expenses is for you to start to receive that income, right? To acquire, to start putting your business operating apparatus. So that's not deductible. In a way, if you look back, you can tie back to section 14, where we talk about various things like it cannot be, it can be deductible if it's not a capital expenditure. So just to quote example on capital expenditure, if I'm looking at, I'm taking a loan to buy an equipment for use in my business, so that repayment of that principal sum, right? Okay, so the principal sum is a capital expenditure, repayment of the capital sum is a capital expenditure. So it's not deductible under 15.1c. But if let's say that equipment is acquired to is to produce income, then the expenses incurred on the loan will be deductible under section 14.1a small one. So that's where you have to make a distinction between the two. I'm just quoting as I go along. I may just quote some more common examples for you. Okay. Then we have capital employed in improvements, that's under section 15.1b. So if it's money spent on improvement or additions to factory, then that is not deductible. Okay, again, we can tie back to section 14.1, where we are saying that if it's like a renewal or repairs, we can allow, but anything that's for improvement, we do not allow. So actually, you can see a lot of these subsections under 14.1 and section 15. It more or less reinforce each other. Under section 15.1f, we are talking about the rental, that if it is not deductible, it is not for producing income. So an example here is a shophouse unit, where the ground floor is a retail shop, while the upper floor is for private accommodation. So the rental expenses attributable to the upper floor is not deductible against the income of the retail shop. Again, you can find a reinforcing section under section 14. Okay. Then we have section 15.1g. Section 15.1g talks about income tax paid or payable in Singapore or other country outside Singapore. So in this case, the example given here is corporate tax paid in Singapore is not deductible. So you can see here, we specifically said that income tax paid in Singapore or other countries is not deductible. In a way, the other way that you can see is that actually income tax is paid. Is it really not incurred in the production of income? Okay, it is an expense that after you have already incurred, you have already earned the income, then you pay something. So not really related to the production of income. So Moving on, we have section 51K, motor vehicle expenses. So this is something that we see very often in the tax of companies, and it is something that you definitely have to know and make adjustments. I think of course, no problem for the larger companies, but for the smaller companies, we see that this is quite a common mistake that's being made. So under section 51K, any outgoings or expenses incurred directly or in the form of reimbursement, and any claim for the cost of the renewal incurred on and after 1998 in respect of a private car, a private passenger estate car, it's not deductible. Okay, to put it in short, mainly if it is like those normal type of car that is not for transporting more than 7 people, like your normal type of car. estate is what you see most often on the road. Those normal type of cars are not vans, but those cars, they are generally they are not deductible. Okay, the expenses related to them, they are not deductible. Okay, so the thing to know is that sometimes for some people, it may not be that intuitive. So it's not just on the car alone. So it's also expenses incurred directly or in the form of reimbursement also. So if you look at the examples here, the non-deductible items will include reimbursement of private car expenses incurred by employees. So here, the cars actually belongs to the employee. Okay, but even if the employee, let's say, may be in a position of doing sales, that they probably need the car to go around the island to visit clients, to maybe do some delivery using their own private car. In this case, if the company reimburse these employees on the, let's say, petrol costs, maintenance and things like that, they are not deductible. Okay, so this is one thing that you have to remember. So even if it is for business purpose, okay, it is not deductible. Okay, the exception to 151K is if it is a taxi or it's a motor car registered outside Singapore and used exclusively outside Singapore. Or a private car, a hired car if the person is carrying on the business of hiring out cars. Okay. Then your Q plate car. Now we don't see a lot. Q plate car used to be cars that are registered under the company's name. Okay. And then if the motor car is actually registered to be used for teaching purpose, okay, and it's quite specific. Here then all these items listed here, the expenses incurred are actually deductible. But in most cases where we are looking at a normal company which is not doing any of these activities, the reimbursements, all these in respect of private car, they are not deductible. Okay, so this is a table where we show the common type of expenses, motor vehicle expenses and their tax treatment. So for the private passenger cars, sometimes I would just say private cars in short. They are not deductible. If it is a foreign registered car used exclusive outside Singapore, deductible. Reimbursement of employees' estate car expenses, not deductible, even if they are for business purpose. Then we have the transport allowance to staff. Is deductible as part of the staff costs. But this transport allowance is taxable as part of the employee's income, employment income. Okay, so what's the difference between this transport allowance to staff versus the reimbursement of employees' expenses. So for a transport allowance, we're really looking at a fixed sum every month, regardless of how much the employee spend. So, for example, it could be this person owes let's say a sales position that needs to travel around very often. So let's say the company is saying that I'm giving like let's say $1,000 every month to the employee, okay, to help him out with the transport expenses. There is really like no condition to say that it must be must be used on private car or for public transport, or even if let's say the employee only spend about $800, the full allowance of $1,000 is actually being paid. So this is the difference between an allowance that is regardless of how the employee spend the transport amount, regardless of whether the employee actually spend the full amount also. So for this, it is deductible. Okay, even though let's say the employee may be driving a private car. Okay, but for the reimbursement of employees' estate car expenses, okay, reimbursement meaning that it's really how much you spend, I reimburse you on that amount. Okay, so in this case, the reimbursement part is not deductible. Okay, so as to versus, if you look at the transport allowance, there's this statement here saying that the transport allowance is taxable as part of the employee's income. For the reimbursement of the employees' estate car vehicles, we'll still bring it to tax. But for taxi, okay, usually I prefer you raise your question to unmute yourself. Sometimes I cannot jaga the chat thing. But for reimbursement of taxi, that we will generally, if it is for business purpose, then that is not okay. I put it this way. I don't confuse myself. So for reimbursement of taxi, for staff for business purpose, that is deductible. Okay. Like I say, as much as possible, I want to scope the questions here to the issue of corporate tax, so that we can cover the course content. If you have questions on the treatment of individual income tax, then please you can check with the helpline or check with your tax agent. Okay. Whether Grab Gojek can be claimed as taxi? Yes. I mean, claim as in, I think, okay, all my answer here will be more on whether the company can claim a deduction. I'm not here to answer your personal tax question. So for Grab taxi, all this is we view as a form of public transport. So the deductions, the company can claim a deduction. Okay, so we view it as a public transport, even though the driver is driving a private estate car. Okay, now I'll move on. Okay, these are deductible expenses which I've extracted from the IRAS website. These are also the more common type of expenses that you will see in your normal course of doing corporate tax. Okay, so I just list out, I will just go through them very, very briefly, just to read them out so that we have some idea. Okay, so accounting fee, bookkeeping services, auditors remuneration. Yeah, I think we also covered some of them, saying that they are deductible under section 14B. So we have administrative expenses, advertisement, entertainment. So this entertainment must be for business, not for you to entertain let's say not for the directors to entertain his friends. Then this one will be, or family, this will come under the private expenses that will then be not deductible. Bad debts. Bad debts, we have also gone through them last week. So it must be for trade debts, and we have conditions like, it has to be declared as income earlier. Bank charges, commission, so our standard type of staff costs like staff remuneration, statutory contributions to CPF, topping up of employees' CPF retirement account, special account. Then we have directors' fees, directors' remuneration. The exchange laws, the foreign exchange laws, it must be in respect of trade and revenue nature. So the foreign worker levy, insurance premium, legal and professional fees. Okay, all this must be in respect of trade and revenue transactions. So the medical expenses, we have gone through them last week. You can claim a deduction, but anything that's in excess of a certain amount, which we have also gone through the computation last week. Anything excess, not deductible. Okay, but if it's up to that certain cap, then it's deductible. Then your office upkeep. Provision for obsolete stock, that will be, it has to be a specific provision. Okay, and then rental of business premises and property tax. Okay, what about some common examples of non-deductible expenses? Okay, these are also the items that you see very commonly. So yeah, so amortization of your intangible assets, for example, because all these are counting entries. Your bad debts in respect of non-trade debtors. Depreciation again is on your assets, but it's also a counting entry. Donations. Okay, donations not deductible expenses. Later you'll see that it's not expense, but we will allow, you have to add it back as an expense, but we have another provision for donation. Okay. Then we have entrance fees. Entrance fees for, let's say, country club or other club. This entrance fees is a one-time fee that you pay to go in order to join the club. Then we have the exchange laws that in respect of non-trade or capital in nature. Then we have the fixed assets acquisition cost, installation cost. Even though we may not be able to claim as expenses, we may be able to claim capital allowance, which we will cover later. So fines, penalties, these are not deductible. We don't want to compensate the company for breaking the law, etc. Goodwill payment, not deductible. So the Singapore income tax or any tax in Singapore, so any tax on income in a country outside Singapore, not deductible. So interest expense on non-income producing assets, not deductible. Then the rest are more or less gone through them, but it's the flip side. Legal and professional fees, those not relating to trade. Your medical expenses, those that exceed the cap. Non-deductible motor vehicle expenses, we've gone through the table just now. The private and domestic expenses. And then there's provision for obsolete stock, general. This general specific, this is your based on your accounting rules. So these are the common examples that sorry. These are the common examples from the IRON's website. So I would suggest that, okay, for the exams, right, generally we'll be testing on the more common examples. So my suggestion is that you try to remember these common examples so that you don't have to think very hard again in the exam if you see similar items, because you can't run away from it one. Okay, these are, like I say, common types of expenses that will be incurred by the company. Then for those of you, I don't know, let's say those who didn't attend the session last week, like I say, there will be question 1 and question 2. Like, I have to qualify myself again. whatever that I say here on the exams is only for question 1 and question 2. Okay, so question 2 will be a tax com, which you will see all these expenses are being reflected in your tax com. Then you have to make a decision on whether it is deductible or not deductible. So if you more or less, if you don't do corporate tax that often, right, then I'll suggest that you try to remember them. Then it's easier that way. Okay. Okay, so now we will do a poll to check understanding. Okay, so as usual, I've launched the poll, so you can answer the questions and then we'll go through them. Okay, I'm going to end the poll and then we'll see what are your answers. Okay, so I've shared the result. The first question is whether the legal fee incurred for incorporation, whether this expense is deductible. Okay, so most of you answered not deductible, which is correct. Okay, so anything that relates to incorporation of a company, incorporation is to really set up a company, right? So this is actually a capital expenditure. Okay, it's a capital expenditure to put you in the position to earn income. Okay, this is where you set up. This has an enduring benefit because once you set up, it's there. So it's a capital expenditure, so it is not deductible. Okay. Then we have reimbursement to a marketing director for using his own car for business. Okay, so okay, I think this one most of you got it correct. Not deductible. So this is what I've been trying to emphasize just now, right? So even though this is also like a trick. I mean, if it's in the exam, then it's a trick question. So so here we are saying that so long as it is in respect of private car, right? Own car is which is his estate car, private car. Anything you incur in respect of that is not deductible, even if it is used for business purpose. Okay, that's under the 15(1)(k) lah. I say this is a very common mistake that we see companies make, the smaller companies make, thinking that if it is used by my staff for business purpose, then it's deductible. No, okay, it's not deductible. Taxi and MRT expenses for staff to attend meetings. Okay, so this we view it as this is a business trip. Okay, so and for taxi MRT expenses, it's a public transport. For business trip, we view it as that it is incurred in the production of the income of the company to allow your staff to attend this business meeting, so it is deductible. Okay, so then lastly, the donation to Red Cross Singapore. Okay, I think to be fair, I've not touched on the part on donation yet, but this question, not so much to test understanding, but more to highlight a point early now. So for the company, a donation will be an expense, okay? But you have to remember that donations, they are not a deductible expense. You don't need to incur the donation in order to carrying on your business. Okay, so in a tax com, for example, the exam, you see anything donations, I don't need to look at where it is to. You just have to add back first. Okay, but later on in the session, we'll see that we will do have a item which we can allow donation under. But really, you have to remember one thing is that you have to add back the expense first under the expenses part. Then at the end of the com, then we'll do allowable deduction if applicable. Okay, like I said, this point is we brought this up is just to highlight this point. Okay, I'll stop sharing. Okay, any questions? Or maybe not, I will do we have another quiz for deductions. Okay, in the exams, right, you will definitely be tested on expenses, not just in the tax com question, which is in question 2. It will also be in question 1. There will be short question and answer where you'll be asked about, whether these expenses are deductible. Okay, so I'll launch the poll now. Okay, we'll do another round. So the question is whether these expenses incurred by a real estate company are deductible. Okay, whether these expenses incurred by a real estate company, whether they are deductible. Okay, so again, you key in your choice and then we will check the answers as well. Okay. I see, at least I see a response. At least I know that the poll is working. Yeah. Okay, I think I'll end the poll now. Sorry about that. I realized that when I look down at the questions, it seems that we have not done our poll answers that correctly for question 3, 4, 5. So the first item is actually deductible, huh? Not the other item. Sorry about that. I'll just highlight this to the organizer next time. Okay. So okay, so I hope that you have your case study 1 with you. Sorry about that. Now I'm looking at case study 1. Okay, actually these questions, they are actually in your case study 1 question, part 2. Yeah, just give you some time to retrieve your case study 1, part 2 answers. Okay, I hope you have them with you. Okay, so like I said last week, I'm also quite exam focused. So you have your case study 1 questions with you, part 2. In the exams, you would be asked these type of questions, whether a certain type of expense is deductible or not deductible. So if you look at the format that we have provided for you under the answers, like I say, how the marking point would be the answer deductible or not deductible. Of course, in the exams, you don't have not sure. So if you say deductible or not deductible, if it's the correct answer, half a point given. Okay. Then another half a point will be given on your reason for why you think it is deductible or not deductible. Okay, so we'll run through the answers now. I'm referring to the answers of part 2, that's in page 2 of your case study 1. So whether these expenses incurred by real estate company, whether these are deductible. So the first item, gifts and refreshments for clients. Yes, this is deductible. Okay, because it's a revenue expense incurred in the normal course of the company's business, and therefore incurred in the production of income. So from what I see, most of you got it right. Okay, so I'm not sure those who think that it is not deductible, why you think it is not deductible. If you want, you can just raise them. If not, then I'll just take it as that. Moving on to question 2. Okay, advertisements for property launches. So this is a real estate company, right? So this is in their normal course of business that they have to put out advertisements to sell their inventories, in a way, if I put it that way. So it is deductible. Here again, it's a revenue expense incurred in the normal course of company's business and therefore incurred in the production of income. Okay. Moving on to item 3, entrance fees for corporate membership to fitness club. Okay, let me see. Okay, most of you said that it is not deductible, which is also correct. Okay, so it is not deductible because it's capital in nature, being once and for all expenditure, deriving enduring benefits. So this entrance fees is to let you join the club. Okay, so once you join the club, this is an enduring benefit. That's how we see it. Okay. Oh, sorry about that. Yeah. Yeah, thanks. Anything that y'all find is like missing or what, you can just highlight it. Sometimes it's okay, like miss out. Okay, but yeah, sometimes I don't check the chat. Yeah. Then general provisions for repairs and maintenance, not deductible. Okay, here the keyword here is general provision. And because it's a general provision, okay, actually income tax wise, normally if it's general provision, we don't allow exception already, because the the liability has not been incurred. It's just a entry by the company, booked by the company, has not been actually been incurred. Okay. So in a sense, what if you remember what we talked about incur, right? In this case, there's no obligation to pay yet. It's just a accounting entry. Okay. Then the interest incurred on loan taken to purchase office premises. Here I think we have different views. Deductible 59%, not deductible 41%. Okay, so here the keyword here, I mean, one of the keywords that you have to look at here is interest. Okay, is interest taken on loan to purchase the office premises. So office premises, I take it that this is a place where the company conduct their business. Okay, so one thing is it for business use? Yes. Okay. The other question is for business use, yes, but is it a deductible expense? Okay. Then the thing here is that now we are looking at the interest component. Okay. So if you remember under section 14(1)(a) small 1, right? Here, if it is interest incurred to take up a loan, okay, to acquire capital that is to acquire income, that is deductible. Okay, so the correct answer here is it is deductible. Okay, versus if this question is in another way, I think the loan taken to purchase office premises. Loan taken to purchase office premises. So in that case, the repayment of the loan is a capital expenditure. Okay, then the capital expenditure, if you remember under section 15, we do not allow, it's not deductible. So you have to make a distinction between the two. Okay, I hope this is clear. If it is not, then you let me know. Okay, then the last question is actually cost fees for staff to attend external cost. Basically, this is talking about external cost. So most of you responded as deductible. Some 20% say not deductible, others say not sure. Okay, so in this case, it is for staff to attend courses. I take it as, in a normal business that they attend course to upgrade themselves. They come back, they can increase productivity and things like that. So this course fees will be deductible. Okay, and then you see the answer, right, in your case study. It is the same answer, revenue, expense, things like that. Okay, so I just want to go back to the exams. Okay, here we go through some of the examples of expenses, and just now I've also gone through with you on the common type of deductible and non-deductible expenses. But really, it's not possible for me to cover every expense under the sun. Okay, and so when it comes to exams on the question of whether expenses are deductible or non-deductible, you will have to apply the principles learned. Okay, those principles that we covered last week and this week. Okay, and then you have to apply them and then decide on the tax treatment. Okay, but one thing that what I can tell you is that if you look at some of these answers here, right, I would say that they are almost like model answers already. In the exams, I don't need you to think about creative answers, but just answers that, because it's just half a point, half a mark, 0.5 marks. No point spending time to be creative about your answer. You don't need to write a para. So if it's applicable, you can almost like plug in if, for example, it is a revenue expense incurred in normal course of business. You can just write that in already, almost like what has been provided for in this answer sheet. Or if let's say it is not deductible because it's capital in nature, because deriving, for example, it's capital in nature, then you can just write that. Like I said, it's just half a point. I don't need you to write paragraph about it. Okay, so this is just an indication. So in the question answer, you also have the other flip side, income, whether you see it's taxable or not taxable. Again, if you look at, you just need to tell me taxable or not taxable, half a point. You will be asked on the reason, then you can state the reason. For example, if it's not taxable, it's capital in nature, we don't have capital gains tax. Revenue, if it's taxable revenue, it's actually acquired the normal cost of business. So just to the point form. Okay, so long as I see your point, I will forward mark maybe. It's also like half a point. And even if you don't know the reason, you can just hazard a guess. Okay, to say whether it's taxable or not taxable, if it's an expense, deductible, not deductible. Even without the reason, but you get that tax treatment correct, I'll give you half a point. Yes, so I hope that this will help you prepare for your exams. Along the way, I will where I remember and applicable, I'll just share this exam tips with you. Of course, I also hope that you do well in your exam. Okay, any questions that I'd like to raise before we move on to the capital expenditure, capital allowance? Okay. Okay, supplementary slides. What do you need to do with them for the exam? But like I say, the corporate tax universe is very wide. I will not be able to cover everything. Even whatever is in a textbook is not the whole universe also. So for this supplementary slide, it's good for reading for your own daily work. But at least for the exams, okay, if it's in supplementary slides, you don't need to know them for the exams. Okay, so here I'm trying to help you to scope already. Okay, so supplementary slide don't need for exam. Okay, but you can still read them for a daily work and for your own understanding. Okay, any questions before I move on to part 2? Anyway, if there's any questions, we can still address them as we go, okay? At least we make sure we have time to cover the contents. Okay, moving on to part 2. Okay, this is what we'll be covering for part 2. Capital allowance is a big component. I mean, not a big component. I mean, I meant it to be, as you will also see it in your tax com. Okay, so for capital allowance, we need to look at what is the meaning of machinery and plant, because capital allowance is given on machinery and plant. Unfortunately, it is not defined in Income Tax Act. So we have to give this machinery and plant their ordinary meaning. Okay, but in this case law, what we can see is that it is for a company, it is to be, it's an apparatus that is used by a businessman for carrying on his business, but not his stock in trade. Okay, so it's all these things that it can be movable or fixed, which he keeps for his permanent employment. So basically, it's like fixed asset type, where you keep it in your business in order to generate income, versus your inventory where you sell them to generate income. Okay, machinery, I think, should be still quite easy to understand. It's those machine where it has moving parts. Okay, so this will be your items like cranes, computers, etc. All this can qualify as machinery. Generally, we wouldn't have much problem with machinery, okay? But we may encounter problem when it comes to plant. Okay, so maybe you look at what is plant first. So broadly, plant is the apparatus in which a person carries on a trade, business, or profession. Okay, so based on the case law, we have 3 tests that we can use to decide whether the item is a plant. Firstly, a plant cannot be stored in trade. Okay, then does the item function as an apparatus that is used for carrying out the business or trade activity? Okay, then we also have the premises test where is the item the business premise or part of the business premise? Okay, so if it's part of business premise, then it's not a plant per se. Okay, so again, what are the principles that we will consider to decide whether an asset is a plant or not? Give words their ordinary meaning. Okay, the equipment used in a business, right, will generally qualify as a plant, provided that it has some degree of durability. Okay, it does not include the place or setting in which the business is carried on. Okay, as to whether an item is a plant or setting, we really have to look at what are its functions. Okay, what are the functions that it performs in the context of the trade in question. Okay, a building or a structure may be considered as a plant if it performs an operational function in the business. Okay, so one example, I mean, these are from the case law. So one example is that, okay, may not be so applicable to Singapore, but if you know, like we have grain, 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 then we have silos, right? Very, very big, round things, structure to hold the grain. Okay, so there was this case law on whether that silo, that round structure, is it a plant which you can claim CA on, or is it just a place for you to store your grain, which part of the business premise, then you cannot claim CA. So for that case, right, they will actually look at what other functions, are there any other functions that this silo perform? So when they look at it, they saw that this structure there is not just a empty building, you know, for the grain to be poured into, but rather inside, it will also have certain functions like you cool the grain and things like that. So that structure itself also perform other functions, operational functions. So in the end, based on the case law, right, it is decided that it qualifies as a plant. Qualify as a plant, then you can claim CA on. Okay, so when I say case laws, this means that actually you will know there will of course be opposing views, and then they go to the court, and then the court make a decision. So sometimes, which is why we say sometimes the case for plant may not be that clear. Okay, then there was a case where we went down to Jurong Island, okay, because the taxpayers is claiming a certain structure as a plant. But then we have to look at how we actually went down to take a look, because it is almost like maybe there's a structure, but they have a lot of okay, it's a chemical plant. Then they have a lot of all these pipes running here and there with various functions and things like that. So we really have to go down to take a look at it and take photos and things like that. And in the end, ascertain that, okay, it qualifies as a plant, not as a structure or building. itself. So like I said, this is where sometimes things can be a bit gray. So we have to really look at the facts of the case and then ascertain. I can frankly tell you that sometimes the controller and the business will have different views. Okay. Then if I look at item F, items of decoration may be plants if the facts show that they create an atmosphere in which is an important function for a particular trade to provide. Example provided here is special lighting to create ambience for a hotel or retail trade. Okay. Then item G, an electrical installation may be planned if it is not for general purpose, but is designed to meet the requirements. I can say this one's a bit debatable, Like another example of that it is not is another example that we have seen before, which is I think also in a case law, that if I ask you, a ship, is it a plant? You think yes, it's a transportation, right? But in this case, the ship is actually used as a floating restaurant. So it's a premise where, it's a restaurant, but it's just based on the ship. The ship doesn't move anywhere. Okay, it's just like there. So in this case, it's ascertained that it is a premise, not a plant. Okay, so you can see sometimes there may be different situation. We have to look at what is specific to that trade. Okay, so this is a case, court case that went up, which is also quite interesting. So in this case, the company is in the business of providing accommodation, which is those prefab dormitories. They provide all these portable and demountable places for workers to rest, to sleep in. This is the company's business. So let's say now I'm in construction site A. The construction company engages this company to build these prefab dormitories in that site so that the workers can rest there. Okay, so then after this construction project has ended, this company will dismantle them. Okay, and if let's say they have another business, they may have to move to another construction site B and build this type of dormitories. So the question there is whether this building, because if you look at it, dormitories is for a place for people to rest, right? So is it like a premise? Okay, so that is the question in dispute. So of course, in this case, if it's dispute, this means that earlier the controller of income tax will say that this is premise, it's not a plant itself. Okay, but the court has actually considered various points. So they will look at the asset's exact operational role in the taxpayer's business. What is the physical nature and characteristics of an asset? So what is the use? Okay, and then location of the asset. Then whether the asset forms part of the building. So in this case, although the asset is part of the building, right? But the dormitories itself, they are supposed to be dismantled, okay, and moved to another place as and when it is necessary. So this is part of the company's business also. Okay. So in the end, the court has decided that, because of this company's business of providing accommodation on a temporary basis, commercially, these dormitories are required to be portable and demountable. And then the court decided that this type of dormitories, although they are building, okay, but it's also qualify as a plant, then qualify for CPA. Okay, like machinery is easier, but plant sometimes we may have dispute. So this is just a case just for info. Okay, so now it's 10 a.m. Our pause here, we will go for a 10 minutes break. So I see you back at 10:10. Okay, thank you.
Shani, I will take over your screen, okay? To trigger
Okay.
the timer.
Okay, thank you. Okay, thank you, Jocelyn. Okay, we will start the session. Yeah, I hope most of you are back. Anyway, so just now we have covered this case law just to show you that there can be difference in views on the determination of plant and machinery. Okay, so this slide shows the examples of items that can be considered as plant or machinery, meaning you can claim CA capital allowance on. So actually, Iris has also an e-tax guide on this. You can also take a look at it. So I'll just go through briefly on some of the common items. So we have aircon and other mechanical installation, blinds and curtains. Okay, so actually I think sometimes, I mean, at the mid, if I'm not doing corporate tax, it may not be intuitive to me on whether certain things you can claim CA on or not. So, but if you do this often, then you know that these are the standard, quite standard stuff. So if you don't do it often, then I suggest that for the purpose of exams, you just remember them. Okay, so blinds and curtains using automation and control systems, built-in storage units and dispensers, carpets and carpet tiles, data and telecom cables and wiring. You also have the electrical and electronic equipment and wiring. So like your aircon system, security alarm system, sprinkler system, and stuff. Then you have furniture and fixtures that are not structural component of a building. Okay, if they form part of the building, right, then they are not considered as plant. So this must be not structural to component of the building. Then your motor vehicles. These motor vehicles are not your estate cars, but your goods and commercial vehicles, such as your pickup truck, van, lorry, bus, motorcycle, bicycle, etc. Then you have your normal office equipment. This one can be a lot. Common items will be like a computer, modem, maybe now seldom use printer. Okay, then partitions. Partitions will be those that are movable and demountable. Okay, but I exclude those functioning as walls or ceilings. Okay, so these partitions, if you remember previously, we have deduction under 14, and those are not movable type. So you can see certain partitions we can claim CA, certain partitions we claim under the R&R, the renovation part. Then you have your security installation, signboard and other signage. Like I say, for exam purpose, you can just for speed, I think can just remember all this. Okay, talk about capital allowance, right? Just want to talk about machinery, plant machinery, where you can claim your capital allowance on. So who is entitled to capital allowance? These are persons carrying on a trade, business or profession and incur capital expenditure on the provision of a machinery or plant for that trade, profession or business. Okay, so generally, if you're a company carrying on a trade, and you will incur capital expenditure on plant machinery for a trade, then generally should be applicable. Although the question here is whether how you define, look at whether it falls under the definition of plant machinery or not. Okay, so what about the qualifying expenditure? Okay, this will include all costs incurred in acquiring the plant or machinery. This will include, if we are looking at motor vehicles, right, this will include your COE and registration fees of vehicles. So this capital expenditure, if you look at it, it's more like it's a capital allowance is on your capital expenditure of plant and machinery. This will also include your delivery cost, Okay, your setup and installation cost, and incidental costs on alterations to building, and this is under section 22. This would be, for example, if let's say your factory now you need to install machinery, and let's say you need to strengthen the floor in order to make sure that you can hold this machinery, which is very big and heavy, right? So if you do alterations to the building, to the floor, for example, in order to manage the weight of the machine, then that will be added to your cost of machinery also lah, that you can claim CA on. Then also removing of the installation cost. So all this, if any, right, this will be added to your cost of that machine or plant. Okay, but you need to take note of what is not included will be your financing cost. So this will be, for example, we talk about take up a loan, you pay interest on the loan is to acquire the machine. So for this financing cost, if applicable, right, you can claim the interest expense under section 14(1)(a)(1), if provided conditions are met. So, so this point is to highlight to you not just the basic cost of machine that you can claim under CA. Okay, with all these items here that you can include and claim under CA, but make sure you exclude the interest cost. Okay, so in this case, if I go back a bit, I said that this is for a person carrying on a business or trade. So your normal trading company, you can claim, but if let's say a company, right, that only derives passive income, for example, the investment holding company, then they cannot claim CA on. Okay, but for example, of course, we will be looking at a trading company. So the investment holding company part is just for info. Okay, so we know who can claim CA. What is the qualifying expenditure? Now does it mean that we can claim it all at one go or what? Okay, this is what we are going to look at now. Okay, so the thing is that we may not be able to claim the capital expenditure incurred, assuming it's a qualifying asset all at one go. Okay, may not So there are two types of capital allowance that we generally segregate them into. One is under section 19, where we write off over the prescribed working life of the asset. Okay, then this can be quite long. 6 12 16 from YA 2023 onwards. And then before, okay, again, for those who were not here last week, our exams will be for YA 2022. Okay, so in this case, for YA 2022, you'll be on if I'm looking at the normal over prescribed working life of the asset, it will be 5 to 16 years. We have to look at this schedule. Okay, so there's a question on whether the list of assets, prescribed working assets, will be provided in exams. So good news and bad news. Okay, the bad news is no, list will not be provided. The good news is that actually we will test you on the accelerated part. So this part you don't need to look at it. Okay, so we are not providing it to you because it won't be tested. So what I'm trying to say here is that the left-hand column side, it will not be tested. Okay, because in the exams, we'll be focusing on the accelerated capital allowance. Okay, so the accelerated capital allowance, here we won't give you a schedule of which section is how many years. Like I say also in last week, you don't need to quote the section for question 1 and question 2. Okay, but you need to know what are the available capital allowance, the accelerated type, because if you read the exam questions, I will ask you to do accelerated capital allowance. Tax com, okay, tax com, we ask you to do accelerated capital allowance. Okay, so usually then this CA will be claimed from within 1 year. You can claim everything, or up to 3 years, depending on the type of asset. Okay, so we'll look at them in detail. Okay, so meaning we are looking at the CA under section 19A lah. Okay, okay. We have supplementary slides on section 19, which you may still need in the course of your work, but exams will be section 19A. So section 19A, right, the CA can be claimed over 3 years. Okay, just now we have computed what is the qualifying expenditure, right? So for example, you add in your delivery cost plus your cost of machine. Okay, so that's your qualifying expenditure. Okay, under section 19A1, right, you would actually claim over 3 years, equal amount, so it's 1/3 of the qualifying expenditure. It's on due claim. Okay, so due claim, right, meaning you can choose to defer. Let's say, even though you have incurred it, you can choose not to claim this year. You can defer it and claim later lah. Okay, and this, I say, claim over 3 years, it need not be claimed in 3 consecutive years. It's not to say once you start to claim in year 1, you have to claim in year 2, year 3. You can claim in year 1, stop, no claim in year 2, year 3, then you claim in year 4, for example. Okay, but you'll be over 3 YAs, so you need to divide by 3. Okay, so it can be allowed even if the plant or machinery is not in use at the end of the basis period. Okay, so this is over a 3-year claim. So how does it work? If you look at this example here, I have the cost of equipment. So this cost of equipment that I state here, I assume that, you know, any other cost, it's not just a pure cost. If applicable, you have the delivery cost, your strengthening of that building cost, your COE, etc., depending. So I have the cost. Then I claim because it's over 3 years. So my first year, let's say my claim in YA 2020 is 75,000 divided by 3, that will give me 25,000. Okay, then my tax written down value as at 31st December 2019. So assuming here for this company, the financial year ends in December. Okay, then it'll be 50,000. Okay, then let's say in YA 2021, I defer the claim. Okay, so for these 3 years, I can choose to defer, right? So I don't claim any. So my tax written down value as at 31st December 2020 will be 50,000 because I didn't claim any CA, right? Okay, then let's say it comes to YA 2022, I claim. So it must be 25,000 because it's always 75 divided by 3, right? Okay, so it's 25,000. Then my tax written down value as at 31st December 2021 is 25,000. Okay, so this is how the claim for CA goes. Okay, this is to show you, like, for each equipment, how the deduction is being made, and also to show you that you can defer for this section 19A1. So the 3 years one you can defer. Okay. Okay, now we have another one which is even faster. Okay, over 2 years. But this 2 years is only for specific YAs. Although maybe in the recent budget announcement, you will have known that we have allowed for later YAs also. But not to cause any confusion, we will just focus on because it will also affect YA 2022 so we'll just focus on YA 2022. Okay, this is 19A1E, which we allow the allowance to be claimed over 2 years. Okay, but very specific on on the capital expenditure. So if you look at the left-hand column, okay, so capital expenditure incurred in year 2021. Incurred 2021, then CA is 75% of the capital expenditure. Okay, 75%. So if you are, I said right, in the exam you'll be required to do accelerated. Okay, so if your expenditure is within these years, incurred within these years, you have to do accelerated. So accelerated, the fastest one where applicable will be 2 years. So you have to remember the formula is 75% for first year, 25% for second YA. Okay, and if you look at the words in blue, you cannot defer the capital allowance. Okay, so in this case, it is very specific. Okay, I just want to highlight again, it's very specific. Capital expenditure incurred in YA 2021, you have, if you want to go for this accelerated 2 years, you have to claim 75% in YA 2021, and then the remaining 25% in YA 2022. Then for capital expenditure incurred in YA 2022, okay, you have to claim 75%. This is YA 2022 is your first year of claim, you have to claim 75%. Okay, then remaining 25% YA 2023. So here you already see, like, for different capital expenditure incurred in different years, it will hit your YA 2022 differently, depending on when the capital expenditure is incurred. Okay, it's on due claim when filing tax return. Election is irrevocable, meaning once you say you want to claim, you cannot later on choose to say, hey, I don't want to claim anymore. I don't want to claim this accelerated 2 years. Okay, so it can also be allowed for apply and actually not used at the end of the basis period. So okay, like I said, exam-wise will be accelerated, but in the normal course of your work, non-exam, the company can still choose to claim 3 years, or then they can choose to claim under section 19. Okay, no problem. I want to highlight. So no problem if you want to drag on your CA claim, because sometimes depending on the company's circumstances, let's say company is suffering a loss, maybe then they don't see the need to want to accelerate this CA claim. So the thing is that the larger your CA, the smaller is your chargeable income. This means your tax bill will be smaller. So that's usually why people, when they are in profitable and a normal profitable case, most of them, they will want to accelerate their claim so that you pay less tax. And then for those who are doing accounts like tax, the good thing is that once you finish the claim, then you don't have to track this assets anymore. If not, it can be quite painful if you're tracking over 10 over years. So it's quite usual that we see companies accelerate their claim for CA. Okay, then we have another one that's even faster, 1 year write-off. Under section 19A2, okay, we allow 100% write-off, 100% allowance of the qualifying expenditure. It's also upon due claim. Okay, but this is very specific. It's only for computers and automation equipment listed. Okay, so very specific. Okay, but I say you can choose to look at the rules, but I'll say for exams, right, you just remember that all these computer stuff, printers, scanners, data communication, your modem, router, software used for automation service, accounting, HR, payroll, all this, you can claim under this 100%. Okay, what I'm trying to hint here is that you just remember all this, that so that in the exam it's easier for you to know what to apply on. Okay, so you may also ask, okay, for example, in a normal case, if it's not an exams will require you to quickly claim your CA. In a normal case, when it comes to computers, the fastest to claim is 100%, but the company can also choose to claim the 1/3 or the 75%, it's okay. Okay, so I just want to highlight to you that it's not to say anything that's computer you must claim under the 100%. You have a choice on this type of normal type of claims. You can claim under this. Okay. But if let's say it is not those computer and prescribed automation equipment, you don't have a choice of claiming 100%. Then it's more whether you are claiming 75% or that 1/3. 3-year write-off. Okay. Okay. Then moving on, we have another type. This is also accelerated 100% claim, but these are for low value assets. Okay, so this is a 100% of your qualifying deduction also on this thing. Okay. Asset. This asset must be no more than $5,000. Okay, each. Okay, and the total claim for all such assets, right, is actually capped at 30,000 per YA. 30,000 per YA. Okay, so small thing. If each is like just cost extreme case, although assets usually it be something that's not very cheap one, but extreme case, if each just cost let's say $100, maybe I can claim like 300 of these small assets. So long as the cap of 30,000 is imposed per YA. But if I have an asset that costs $5,500, sorry, I cannot claim under this 100% write-off. Okay, so the thing is that if I have a lot of assets, right, then let's say all are under $5,000, but I hit the 30,000. So what do? You claim up to 30,000. Okay, but this is on a per asset. So you cannot, where let's say the last item is like $1,000, but after let's say you put all these items under the 30,000 is what? $29,500. Your next asset is $1,000. So if you claim the asset, you will hit that 30,000, then you cannot claim the asset. Just claim the asset under other capital allowance, which can be on the 2 years or 3 years. Okay. So this is what it's trying to say. Anything that exceeds that cap, you can still claim all these small value assets under other CA part. Okay. But of course, if you look at it, let's say I'm a company that I want to max out the CA claim. The first thing that you'll go for is, if it's all these printers, etc., I want to claim all under 1 year already, because this one no other rules except that must be this type of assets that I claim. Then if you have small items, then I look at whether I can max out my claim under 19A, 10A. For those remaining one that I cannot, okay, then I'll claim under the 2 years. This is what I'll do, or you can do if, let's say, in the exams you say you have to accelerate your claims, right? Okay. This is just an example on the CA claim for 10A. Basically, this is just to show your furniture, assuming let's say each is let's say 5,000, so I have like 6 of them or whatever, then just nicely 30,000. So the remaining, so 45,000 less 30,000, I have 15,000 left, right? The remaining 15,000, I can claim divide by 3. Let's say normal work, not by 10. Claim divide by 3, then I'll claim 5,000 per year. Or if I want to accelerate, right, I can claim 15,000 times 75%, $11,250. Okay, so let's say in this case is I'm claiming the remaining under 3 years. So my tax return down value will be 10,000. Okay, maybe you look at one example. So we assume financial year end is December. Okay, equipment purchased in YA 2020, but I didn't claim CA. CA is only claimed from YA 2021. Okay, then I have my furniture and computer that were purchased in June 2020. So June 2020, this will mean that it is for YA 2021, right? Then I have my movable partition in stock in March 2021. This means that the first claim that I can claim will be YA 2022. Okay, so if I look at the table, equipment cost $75,000. Although I bought it in YA 2021, I'm going to defer it. Then I claim over 3 years. Okay, so in this case, I cannot claim the 2 years, right? Because the 2 years only applies for expenditure incurred in YA 2021 and YA 2022. Okay, so this one, even though my first claim is in YA 2021, but when I incurred the expenditure, it's not within that qualifying period. Okay, so I claim over 3 years. Okay, computer. I know computer, I can do the accelerated claim 100%. Furniture. Okay, furniture, in this case, based on the information given, each cost not more than $5,000, so I can claim like under the small value asset one. Okay, so just nice, let's say 30,000, then I claim all at one go. Okay, then for this machine that I purchased in YA 2021, in this case, I can accelerate my claim 2 years. The first year will be 75%. So you always remember if it's 2 years, 75%, then the remaining 25% is the 10 year. And this one you cannot have a gap in between. Once you start the claim, you have to claim consecutive years. Okay, movable partition, also the same, I'm going to claim accelerated. So you look at this table, right? So if the question or in the tax com, let's say when you're doing YA 2022, right? Then you have to know, for example, you will not just look at the equipment or asset that is purchased in year 2021, okay? But you also have to look at earlier years to see whether there are any like carry forward value for you to claim. So in this case, for YA 2022, the CA claim is $61,250. Okay, so this is something like that 14N that we have looked at previously, right? You also have to look at previous years, whether there are any values that are carried forward or not. That is accelerated CA. So for hire purchase, okay, hire purchase, these are like companies that are paying installments, but because paying installments, right? So they also have to pay interest for the high value of money. So they also have the hire purchase interest. Then what I want to emphasize is that for that hire purchase interest, right, you cannot claim CA. Okay, you'll claim under your 14(1)(a)(1), provided the conditions are met. Okay, but your capital repayment, your capital repayment, you can claim CA. Okay, and of course, capital repayment, because it's like monthly pay, it is not one shot the full capital amount. So it's only when you incur that capital amount for that YA, then we allow to do the CA on. Okay, and the same rules apply on the capital allowance that you can claim. Okay, so here just saying that the 2 years accelerated claim, the 75%, 25% is also applicable for installment purchase. Okay, so in this case, this is in this example, it shows that there's initial payment on delivery of $9,000. Then you have your monthly installment. Okay, then the company is going to write off over 2 years. Okay, what I want to say is that, so in this case, you look at what is the initial payment during that YA. So we fall back, that's why we need to know what is the basis period, okay, for that YA. So you look at the YA, what is the capital repayment that you have made? So in this case, okay, there are different ways of looking at it. So if your starting point is on your capital repayment plus interest, then you need to make sure that you exclude the interest, HP interest, to work out what is your capital expenditure. So that will be your sum need towards your that capital cost of the equipment part, not anything on the interest. Okay. Then once you derive the capital expenditure, then you apply the relevant CA section that you wish to claim. Okay, so in this case, it is that accelerated 2-year claim is 75%. Just hold on, I saw something. Okay, so the question is on the 1910A, that small value item claim of that 30K. So do we look at overall group and not look at each item, individual items? If you look at individual items, may not hit 30K. Yeah. Okay. Yeah. So this goes back to that thing that I mentioned just now, right? So you may have a lot of small items, and you add all of them up, you'll be maybe more than 30K. Okay. So in real life, in real life, you really have to look at each individual item. I add them up. Okay, if you have those like sweet comes under 30,000, then that's fine. But if it's like you claim one more item, because it's a per item, so you claim up to a certain, let's say you claim up to 9 items, the 10 item will cross the 30,000 threshold. Then the item you cannot claim under the accelerated 1 year, but you can claim under the 2 years or 3 years depending. So meaning you may have only utilized up to, let's say, $29,000 of cap only. Okay. So then what about in the exams? If in the exam, depending on what is stated there, okay, if they give you what is the per item amount, then you also claim, make sure you don't hit the cap. If there's anything that you hit the cap, right, then you can only claim under that 2 year or 3 years long. So those the items that exceed, that you cannot claim under the 30K, right? Yeah, you claim under 2 years or 3 years. You cannot claim under that 30. Okay, can. Sorry, yeah, I hope that it is clear. Anyway, the cap is there. You cannot bust the cap, Okay, now we move on. Capital allowance for motor vehicle. Okay, S-plate cars, companies cars, Q-plate S-plate, no capital allowance allowed. Okay, you see here we are very strict. Basically, some information is that they want to control the car population. So they say everything cannot allow. Expenses cannot allow, capital allowance cannot allow. Okay, but exception, similar to what we have under the expenses, right? Like these cars registered as private hire cars and cars for teaching, right? This for teaching you can allow. CA, vans, lorries, motorcycles for business use you can allow. Then motor vehicle registered and used outside Singapore you can allow. So like I said, all this is just remember that we have all this treatment. Sorry. Now going back on the tax com, right? That's what we thought about the theory part. Now in the tax com, how do you reflect this in the tax com? Okay, what adjustments that we need to make? Okay, firstly, we need to check. If I look at the left-hand column, okay, if let's say this, although this can happen, some companies, for example, they bought a fixed asset, but they claim they reflect it as an expense in a P&L. Okay, by right, they should reflect under the balance sheet, right? But anyway, we don't care. We just look at what is the correct tax treatment to do. So if it's a capital expenditure, we definitely it's not deductible. We have to add back. Okay, I add back under the expenses part. Then I look at this item. Can it qualify for claim as capital allowance? If can, then we compute what is the capital allowance. Again, you have your what? Small value machinery that computers 3 years write-off, 2 years write-off, and stuff like that. Okay, so important point to note is that if that capital expenditure is included under the expense, you need to add back. Okay, but if let's say that item, right, that capital expenditure is not reflected under expenses, but is reflected under addition to fixed asset, then this one okay, because no deduction has been claimed, right? So there's no such thing as adding back. Okay, so you just need to determine whether can I claim CA? Okay, if I can claim CA, what is the amount of CA that I can do? Okay, so I think as at now, maybe I can refer you to your case study question 2. The answer part. Okay. Case study question 2, somewhere along the midpoint, you will see adjusted profit before capital allowance. There's the amount, then less capital allowance. Okay, so I just want to highlight to you is that when you're doing your computation, usually we are talking about, in this case, it's a profitable company's comma. So if you look at from the top, we have net profit, then we less off the separate source income, then we add the disallowable expenses. Okay, this morning we have gone through disallowable expenses, right? You need to add back. So if let's say you have your capital expense inside here, right? Same as deducted, reflected as an expense earlier under the net profit, you need to add back. Okay. Then you have your adjusted profit before CA. Then after all these expenses adjustments, then you show your CA deduction. Okay, I just want to highlight that this is where your CA, where in point in the capital, in the tax com, your CA will show, will be reflected. For those who are not familiar with the tax com. After expenses, after deduction, then comes your CA. So you don't do like CA up on top. Okay. And like I mentioned, in the exams, right, you need to show workings on your CA. Okay. So like for example, you just say less capital allowance, see working. Then in the main column, just quote an example, in the main column, for example, in this case here, you can just give me 65,500. Okay, I think there's a question here whether you need to show negative on bracket. We'll show in bracket form. Negative for negative figures, it is bracket form. Okay. Then, okay, here in this answer, right, we break down into different allowance and things like that. All this you can show in the workings itself, but you don't need to quote the section. So if I look at the following page, so if I'm looking at let's say I'll just say something different just for easy understanding. Let's say my office equipment is today, this year is the first year that I incur the expense. Okay. Okay, here I need to do accelerated, but if let's say I can just write office equipment, let's say 30K, but because I want to do accelerated, assuming it's only one equipment, I don't do the low value, assuming it's only just one equipment. So I'll just do like 30K times 75%. Right. Then you will give me that sum. So this is for YA 2022. I'm just quoting an example, so it's not the same as what you see here. So when I see that you have your workings on like divide times 75% or times 25% or divide by 3, divide by no division and things like that, then that is your working already. So even if, for example, let's say you put divide by 3 or times 75, if you get your computation wrong, at least I still see that you know what you're doing. May award marks. So this is how it is done. Again, I don't need you to write very nicely. Write something that I can understand, like office equipment can do, furniture, okay, carpet. All in point form will do, but so you're working. And then at the end of it, you will need to add what is the total amount. Then you just port it back to your first page, your tax form. Okay, you don't need to reflect it twice. Just say capital allowance, see working, then you do at the back. But make sure you show it at the back. Like I say, so if let's say you miss out one item, but let's say you get all the other 3 items correct, for example, I will still award points for your 3 items, even though your total capital expense amount is not correct. Okay, this is how I will mark it. Okay. Okay, I move on. Okay. Now I move on to balancing adjustments. Okay, so capital allowance, right, has been claimed on the plant and machinery previously. Okay, when the plant or machinery, right, has been sold off, right, but it seems to belong to the person, whether it's on sale, or in the case of plant and machinery provided for R&D, not for the purpose of taxpayers' business, cease to be used for R&D, or that the trade has ceased, then in that case, we need to compute balancing adjustments because we have allowed capital allowance on that plant machinery previously. Okay, if let's say no capital allowance has been claimed, then we don't need to compute balancing adjustments. Okay, this balancing adjustments, it can be in the form of balancing allowance or balancing charge. Okay, so when the tax written down value, just now when I gone through the computation of the CA, right, I talk about tax written down value. Okay, so tax written down value, if the tax written down value, meaning whatever that has not claimed, whatever CA that you have not claimed that amount, is more than the sales proceeds, then there's balancing adjustment, balancing allowance. Okay, sales proceeds, we would look at it as the deemed sale at open market price. Okay, if it is sold for less than the open market price lah. Okay, or it continues to belong to but permanently cease to be used. Okay, so we look at the two figures, what is the tax written down value versus the sales proceeds. If tax written down value is bigger, then there's balancing allowance. If the tax written down value is less than the sales proceeds, we will compute what we call balancing charge. Later we'll look at examples for easier understanding. But for balancing allowance, you view it as something like capital allowance. I mean, this is just an idea for you to easily understand how it works. So it's something like capital allowance, right? We will reduce your tax payable. But for balancing charge, right, the amount in excess, we will tax it, deem it as an income chargeable under section 10(4). So income meaning it will increase your tax deductible. Okay, but that amount that we are going to deem as income, if it's applicable, we will restrict it to the amount of capital allowance claim. Okay? I think we look at examples and it's easier to understand. Okay, so capital allowance. So in this case, I have equipment that cost $75,000. Then 1 year later, I sold it for 40,000. So my cost of equipment 75,000. Let's say in that year, I claim CA, those 1/3 type of CA. So $25,000. Tax written down value becomes 50,000. Okay, so following year I sold it, right? So my sales proceed is 40,000. The balance is balancing allowance remaining will be 50,000 minus 40,000, 10,000. So this 10,000 I can claim less it off against my income, just like a capital allowance. So remember, balancing allowance works just like a capital allowance. Okay, now I look at balancing charge. Okay, in this case, everything is the same, but not the same but okay, my cost of equipment is $75,000. So over the 3 years, I claim the full 75,000 CA. My tax written down value as at 31st December 2020 is 0. Okay, but somehow I found a good price for it. I'm able to sell for a good price. My sales proceed is $80,000. Okay, so now I have this $5,000 dollars extra. Okay, so now my balancing charge is restricted. Even though my sales price is 80,000, I cannot the balancing charge will be restricted to the CA that I've granted previously. Okay, the CA amount that I've granted previously is $75,000. Okay, so my balancing charge is $75,000, not the $80,000 of sales proceeds. Okay, so this charge is an income I have to add back, and it's taxable. Okay, this is what I'm trying to say, right? Balancing allowance deductible, balancing charge taxable. But there's a cap. Okay, still on capital allowance. There may be a case where this sale or transfer of machinery is actually between related parties, meaning that the buyer may control the seller or the seller may control the buyer, or both are controlled by the party. In this case, they have a choice. They can make an election under Section 24. Okay, when Section 24 is made, right? Wait, if you remember, I say that if I transfer asset in a normal case, I have to compute BABC. Okay, when Section 24 is elected for the seller, I don't need to compute any BABC. Okay, but for the buyer, they will take over that remaining amount from the seller. So the tax written down value of the seller's asset is transferred to the buyer. Okay, and then the buyer claims CA based on the tax written down value transferred in the same manner as the seller would have been entitled to the claim. So what this is trying to do is that it's as if the asset, as if the asset didn't change hands, and then the buyer will still continue to claim as if what the seller would have continued to claim. Okay, and this is possible because these two parties, they are related parties. They would have known, for example, the buyer could actually obtain the tax written down value from the seller because they are related party, right? So I know, so I can ask, okay, so how much is your tax written down value? Let me know, I just transfer it over. Okay, so the good thing upon this is that you don't need to do all your BABC. Okay, just hold on, I have a question. Oh, okay, good for spotting. Good for spotting. Yeah, so I have a question here saying that why the company sold equipment for 105K. Why is it the sales proceed was made at 80K instead of 105K? Yeah, you're right, actually. Sorry about that. I think there's a typo. There's a typo on this. Very sorry. Yeah, thanks for highlighting this. The sales proceeds should be 105K. Okay. Yeah, I think when we change the question, whichever don't know, change question or change answer, forget to change the other part. Yeah, so you please take note that it should be, thanks, okay. It should be 105K, but what is important is that your balancing charge should still be 75K, because that is the CA that you have actually claimed. Will restrict to the amount of CA that you have actually claimed. Okay, yeah, good on spotting that. Sorry about this. Okay, so back to this Section 24 election. Exam wise, you don't need to know lah. This is for your info only lah. Okay, any other questions on CA part? Okay, like I say, supplementary slide. These are various case laws. You can read it one time. They won't be covered in exam. Then 19A, that is the over prescribed working life of asset. Just to show it's a bit different, the computation is a bit different. Some companies, they will still use it. Those in the capital intensive companies that are enjoying tax incentives, they will still use it. Okay, if not, then we'll move on to the basis of taxation. Okay, just already said for exams capital allowance, you don't need to quote the section. You just need to show your working. Okay, basis of taxation. Singapore adopts the modified territorial basis of taxation. Territorial usually means if it's within Singapore source, then we tax. Singapore source meaning income accruing in or derived from Singapore. But Singapore, we adopt modified tariff, meaning here we also tax on foreign source income, but it's not the international tax like US where I tax your whole world's income. Singapore, we don't do that. We only tax your income, foreign source income, if you remit them back. Income received in Singapore from outside Singapore. Okay. So when we are looking at income source, we need to know whether it's sourced in Singapore or foreign source income, because the tax treatment is actually different. Okay, so for Singapore source income, it's subject to tax upon accrual, unless it's exempt from tax. Accrual, not when upon receipt. So if I'm looking at your trade income or under section 10(1), your income, section 10(1), we have your trade income, employment income, dividends, interest, all this. Singapore, if it's considered Singapore source, I'll tax it upon where it's accrued to UAD. Okay. And also under section 12, income deemed derived from Singapore. Versus a foreign source income subject to tax upon receipt. It's only when you remit it. Okay, so even though let's say it's income under section 10(1), okay, although it's accrued overseas, right? I don't tax it. I only tax it when you bring it back to Singapore. Or under section 10(25), income deemed received. So although you may not have actually brought the income back, but under certain circumstances, I deem it as you have brought it back to Singapore, then subject to tax. Okay. So the problem again is that the Income Tax Act, right, does not define accrued in or derived from Singapore. So generally, the source of trade income will be where the business or trade is conducted. For income from employment, usually arises where employment is exercised. The income from property is usually where the property is located or where that particular asset is used. So there's no universal rule for the determination of source, so it depends on the facts of the case. Okay, so these are the general rules. Of course, sometimes there may be dispute one. If we look at the source of trade, right? Look at our operations test generally applied to determine whether the gains or profits from trade or business are sourced in Singapore. We look at the total operations of the trade or business. So the factors that we'll look at, right, will be the place where contracts are made, the place where operations to fulfill contract requirements are conducted, the place where title to goods are passed, and the place where proceeds are collected and invoices raised. Generally, trade-wise, generally, there shouldn't be an issue. Let's say your business is here, generally your income is sourced here. Although your customers may be overseas, but this is where you conduct your business and trade. I say generally, but sometimes, who knows, right? Sometimes there may be dispute, but I say generally. For income deemed sourced in Singapore, it's under section 12. Okay, under certain circumstances, they may be deemed sourced in Singapore. So some example, right? It'd be, for example, if it's for individuals, for those who are performing working overseas, on behalf of the Singapore government, although they work overseas, it's on behalf of the government. Even though they exercise their employment outside Singapore, right? They will still deem the income as sourced in Singapore. But that's also because in most cases, the other countries, they also don't tax the income over at their side. Or sometimes it could be non-resident carry on shipping or air transport. But this one not so, okay, in real life we do have them, but we don't really need to know for exam purpose. Okay, but this one you will need to know that section 1025 deemed remittance provision. Okay, whether or not the source from the income is derived as seeds or any income from any source derived from outside Singapore, right, which is remitted, transmitted or brought into Singapore, applied in or towards satisfaction of any debt incurred in respect of a trade, trade or business carry on in Singapore, or applied to purchase any movable property which is brought into Singapore will be deemed received in Singapore. So for the example, okay, so if the income is outside remitted, I think remitted, no issue, right? It's brought into, let's say, Singapore's, the companies that have a bank account in Singapore is remitted back to the Singapore bank's account, remitted, or let's say the check is actually brought back to Singapore, like considered as remitted. Or even if, let's say, it is not paid in Singapore, but let's say I have a supplier overseas, right? I have a supplier overseas, then I use that money from, let's say, Malaysia. Malaysia, I have customers in Malaysia, I receive that revenue. Then I also have Malaysia supplier. Then I use that money in my Malaysia bank account to pay my Malaysia supplier. Okay, but all this is for my business in Singapore. Okay, so that payment is also considered as deemed remitted. It's also considered as deemed remitted, even though the money is not in Singapore, because it's in respect of a trade or business carried on in Singapore. Okay, then the last bullet point, right, applied to purchase any movable property which is brought into Singapore. So for example, if let's say I have money, then I go and buy a painting at some auction, let's say in Hong Kong. Then I use that trade receipts, right? I go and buy the painting. Then I brought it back to Singapore. This will fall under this 1025, where we deem remittance. Okay, but Iris, we have a clarification, because then everyone will be a bit concerned, right? So it says here that for non-resident individuals or foreign businesses, they are not operating in Singapore or from Singapore can remit their foreign income without being taxed on that income. Okay, then as an admin concession, foreign income that's applied towards overseas investments without being repatriated to Singapore will not be treated as being received in Singapore. Okay, so the taxing point of this foreign income is deferred until the investment is realized and that the proceeds are brought into Singapore. So this is what 1012 is about. Okay, so now the time is 11:16. So we'll take a 10 minutes break here and then we'll continue after that. Okay, so I see you all later. Okay, thank you, Justin. Okay, I'll continue. Sorry, my focus are a bit thin by now. Okay. Okay, so that's 1025. Now we move on to tax residents. For companies, we will say whether they are tax resident or non-resident, same as like individuals. So for companies, right, it's defined under Section 2 of Income Tax Act. Means any company incorporated or registered under any law enforced in Singapore or elsewhere. The resident, right? Resident in Singapore is in relation to a company. It means a company whose control and management of the business is in Singapore. So here we are looking at the word control and management. Just want to highlight the point that it doesn't mean that when a company is incorporated in Singapore, it is a resident in Singapore. For tax residency of a company, we look at where's the control and management. So for control and management, right, it is, if you look at the second bullet point, central management and control is situated in a place where the board of directors exercises the power and authority on strategic policies and decisions. So it's a question of fact. We look at where the directors meet, where they decide on strategic policies and decisions. In most circumstances, we don't have an issue with control and management, but sometimes we may have, but generally should be still quite okay. Then why do we need to know whether a company is a tax resident of Singapore or not? Okay. Tax-wise, right, the way how we compute the tax, the computation, the format is the same. The 17% tax rate will still apply to resident and non-resident. Okay. But if a company is a resident in Singapore, it can actually declare a Singapore dividend, which is exempt from tax. It can also enjoy certain tax incentives in Singapore. And for companies which have transactions with other entities outside Singapore, they also benefit from the avoidance of double taxation agreements, what we call the DTAs, conducted by Singapore, because the benefit to whether you can enjoy the benefits under the DTA, if you look at whether you are a resident of Singapore or not. You can also claim unilateral tax credit, and you can enjoy tax exemption on foreign dividends, branch profits, and service income received in Singapore. And if you are a newly incorporated company, right, you can enjoy that tax exemption. This is all theory, not so, like I say, in your course of work, maybe you may need to know, but not so much for the exam. Okay, then we ascertain, move on, look at your income, how we work out the taxable income, statutory income, etc. Okay, so you have seen the tax com, right? By now, I've shown you like how the tax com would look like. Okay, so in this case, statutory income refers to aggregate income from all sources chargeable to tax. Okay, so it's not just your trade income, but you can be receiving other sources of income like dividend income, rental income, interest income, etc. All these, they are chargeable to tax. And also your foreign source income received in Singapore. Okay, then you net off the deductible expenses. Okay, and then you have to also take into account your CA. Okay, and then what is also saying here is that if you have unutilized CA, meaning last year, let's say last year I paid CA, but my income is not enough to offset. So I have excess CA. This CA can be carried forward into the next following YA. Okay, if I have unabsorbed CA, if you look at that table, before I less off CA, right, for the current year CA, I will less off the unabsorbed CA first. Subject to rules, subject to rules. But just to show you what is the ranking of the CA. So when you make a deduction, if it's a qualifying unutilized CA, later we will see why we have this qualifying, unqualifying. If it's CA that you can use, brought forward, then you less that off first, then you less your current CA. Okay, so now we look at the other sources of income. Okay, I think now you can take a look at your case study question 2. Okay, before I go through that slides, I thought I just let you know usually where you will see this income. So if I look, so you have your questions and answers on hand. So if I look at the question side, right, you will see you have your after sales, you have various income. Okay, this is in your profit and loss statement, your various income. Okay. When I need to do the tax com, right? Okay, the tax com, if you need to remember, the first thing that we need to know is to make adjustments to arrive at your trade income first. So if I look at the tax com, I say I port over the net profit, your answer, right? Port over the net profit. Then I less off those income that are not related to trade. Okay, I need to less this off first. I'm talking about the format of the tax form. You need to less off this foreign source income first, which is what we are going to cover. So you less off all this separate source income, so that whatever income that is left is your trade source. Then you less your expenses. Then you do your CA. Okay. Then if I look at after CA, right? If you look at your answer, after CA, adjusted profit after CA, then you less your unutilized losses brought forward. This is similar to like the CA. Anything that's unutilized from previous year, if they meet the conditions, you can less them off first. Okay. Then you add back. So as at now, it's all trade. All these are relating to trade. Then sorry. Then you add your other sources, other taxable sources in your tax com. Okay, as to whether they are taxable or not, that's what we'll be going through. But so I just want to highlight for those of you who are not familiar with tax form, upfront you need to less off the separate source income first. Then after working out all your trade income already, then you add in those that are taxable income that are subject to tax. Okay, so I just want to highlight this point in the tax com. Case study. Where's the case study? I think they have actually uploaded your case study question 2. Sorry if I'm not clear. Case study question 2, I think you should have it. It should be uploaded in your don't know what portal, or those who have the physical copy, you will also have a copy of that text form. I'm sorry if you do not have it now, then you can refer to it later. Okay, so I'll move on. Okay, so these are we have talked about trade income. Right now we are looking at other sources of income already. Okay, so one other source of income that we commonly see is your interest income, taxable under section 10(1)(d). Last week we went through briefly, right, all the 10(1) something type of income. Interest income. Okay, so interest from deposits with banks and finance companies, they are taxable. So with banks and finance companies, where you have your bank deposits in Singapore, right? Sorry, these are Singapore source income again. But those bank deposits overseas, these are foreign source. Okay. So taxable, then it is accrued to the depositor on the date where they have actually, the bank has deposit that interest to your bank account. Okay, it is not when you have actually withdrawn that interest income for use. Okay, just a note for individual, because for individual, if it's deposit, interest from deposits from approved banks and financial institutions will be exempt from tax. This is for individuals, but for companies, right, this interest income is taxable. Okay, this interest income is taxable, but then the question is that, is it a Singapore source or foreign source? Singapore source, so long as the bank has actually deposit your interest in your Singapore bank account, taxable. Okay. But if it's a foreign source, okay, it will only be taxed when the company brings the amount, remits the amount back to Singapore. Okay, then I move on to another type of income, that is income from REITs. REITs are real estate investment trust. Okay, REITs, it may be a bit complicated. In the sense that even though they make a distribution, we really have to look at what is the nature of that distribution. Okay, and actually, if you all receive the CDP statement, they will state quite clearly what is the distribution, what is the nature of distribution. So what you need to know is that if that distribution is a gross distribution income, okay, gross distribution income, then for companies, right, then this income is chargeable to tax. For individuals, they are exempt from tax. But for companies, this gross distribution income is chargeable to tax. Okay. This is actually income that has been granted tax transparency treatment. So it's not taxed at the REIT level, it's taxed at the unit holders level. That is your company when you receive the distribution income. But if that distribution also consists of components like income that has already been taxed on the trustee, he has been taxed once already, it won't be taxed again on the unit holders, so it's not taxable. Or capital gains or any non-taxable income, also not taxable. Anything that's non-income, like operating cash flows or unrealized income. Generally, you don't have to worry about the distribution, the nature of distribution. Generally, you should be able to see in the CDP statement, or if it is in the exams, right, then you'll be reflected as such. But you need to know which component is taxable, which component is not taxable. Okay. Then adjustments wise, in the tax com, right, you need, okay, so remember I said that at the top part of the tax com, if let's say this REIT has, let's say $100, okay, $80 is on gross income, $20 is a non-taxable income. So up at the tax com, right, you need to add back that $100 first. Okay. Sorry, you need to less off. You need to less off that $100 because your net profit will include that $100 distribution. Right? You need to less off that $100 first. Then you look at the end, right, at the bottom, after you have worked out your trade income part, you add whatever component that's subject to tax. Okay, so that will be your $80. Okay, so this is how it works in a tax com. So just now, similarly for interest, you need to less off the interest first, then depending on what is the tax treatment, later on, after you do your trade income, right? After you add back whatever that is taxable. Okay, so you refer back to the answers in this case study question 2. Anyway, for this case study question 2, we won't be spending time to do it because I think from experience, if I give you half an hour to do, then I need half an hour to explain, then really have no time to cover all the things in the exams. So I rather that I highlight the points to you, and then you use this as an example for you to do a full com yourself. You to just test yourself. Okay, foreign source income. Okay, residents, individuals, right? Not subject to tax, but we are doing corporate, right? So we look at corporate now. So for corporate tax exemption,
Shani, can I just ask, in the exam, right? Is it okay if like depreciation we put like DEPN and then capital allowance we just put CA, and then like fixed D we just write FD? Are those abbreviations okay?
Okay, generally okay.
Okay.
But I also ask you, like, I don't know, now internet you all have a lot of abbreviations. Cannot be too not the tax type one. Not a tax type, then I don't know what you're writing. But if it's like general CA, capital allowance, yes, you can write CA. Depreciation, like the ION, you just put like N. This type should be okay.
Oh, okay.
Yeah.
Okay. Like fixed D, FD is okay?
Yeah, that's okay.
Okay, thank
Foreign
you.
exchange, you put FX, that's okay lah. But really, I cannot profess that I know all the short forms.
Yeah, like
Something
year of
reasonable lah.
assessment and year end.
Yeah,
I think
YA.
should be
Yeah, you put YA,
YE.
that's okay. Yeah.
YE also okay. Okay, thank you.
Yeah, no problem with that. Thanks. Okay, so foreign source income, what is exempted? Dividend income, branch profits, and service income. Okay, those that receive, okay, individuals we don't touch. Okay, those conditions will be the foreign source income is subject to tax overseas. Okay, then the foreign jurisdiction, right, their headline tax is at least 15% at the time that the foreign source income is received in Singapore. Headline tax is just look at what is listed as their tax rate. So even though, for example, the corporate tax rate is 25%, I don't need to look at for that company, does it enjoy tax incentive and tax at less than 25%. I just look at what is the listed corporate tax rate, for example. Then the controller is satisfied that the exemption is beneficial to the tax resident. Usually that's so, right? Then the person will claim. So this is a tax exemption. This would point 3 will actually mean that if, let's say, this tax exemption does not benefit the Singapore tax resident, the Singapore resident can still offer the income to be taxed in Singapore. Even though it's tax exempt, but if it's not beneficial to the Singapore tax resident, the tax resident can still choose to tax this income in Singapore. No problem. Perhaps sometimes it could be some PTA tax rate issue. But this is just for info. It won't be in that sense. So what you need to know is that Singapore one tax exempt dividend. These are dividends paid by Singapore resident company that exempt from tax in the hands of shareholders. So very simple, if you look at dividend income from a Singapore resident company exempt from tax. So your tax form, you let it off, but you don't have to add back the income. Okay, this tax exemption on gains and profits from disposal of ordinary shares. This would mean that, for example, I hold shares, okay, then I sell it off. These gains and profits, is it taxable or not? Okay, if you remember last week, we have gone through the badges of trade. By right, assuming that this company is not in the business of trading, buying and selling shares for normal course of business. They say for investment, but really we still need to look at badges of trade. But this exemption would actually say that if you meet all these conditions, right, I'll give you the certainty not to tax you on the gains of profit. So the conditions are that you need to hold at least 20% of the ordinary shares in the company that you buy the shares. And it is for a continuous period of at least 24 months prior to the disposal date. Okay, so you have to hold it for at least 24 months. And the period that we are looking at is this period that's stated here. I won't read it out, you can see it yourself. So this is for the certainty. Okay. So, what are the tax adjustments that we need to make to the tax com? Singapore source tax upon accrual, regardless of whether income. Okay, no such thing as remitted or not, it's just that upon accrual. Foreign source. Okay, if the income has not been brought to tax, has not been remitted back to Singapore, no tax. Okay, if it's income that is even it's from previous YAs, right? Previous years, but then let's say I add my 2020 interest income, 2021 interest income, add them, then I remit them in year 2021. All this will be taxed in YA 2022. Okay. Now I look at the basis here where it is remitted. I don't need to trace back where this foreign source income is actually accrued. Okay, if it's daily income, then you have to tax. But if it's income that's exempted from tax, then you don't need to tax that amount. Okay, accessible income. After statutory income, what do you need to less off? Okay, we have one whole list here. You have your unutilized loss. Just now I highlighted that in your tax comment where it will be deducted. Then if you have your current year loss, then your current year loss you can offset against other sources of income. Okay, then donations, we will look at that later. Okay, then we have group relief. Okay, we'll touch on them later. Okay, donations. Just remember, as an expense, you cannot allow the expense you have to add back. Okay, because it's not wholly exclusively incurred in the production of income. Okay, so you have to add back. But there's a tax deduction for approved donation. So the thing here is that it has to be approved. Okay. Outright cash donation made to government or IPC does not include overseas institutions. So overseas institution cannot. In exams, I won't expect you all to know which are the IPCs. If it's an IPC, then I would provide the info that it's an IPC. So for that donation part, you can actually claim 2.5 times. Okay, so if you refer to your answer for case study question 2, okay, you'll see that near to the bottom, maybe we're 3/4 down the page. After you add back you add your taxable income, then you less donation. So this donation, right, you will see this working approved donation amount times 250%. In the exams, I will award points for working for donations too. So maybe let's say total donations under expenses is, let's say, 5,000. Then you look at the description, then you see only 1,000 is approved donation, right? So there's $1,000, you state there, give you 0.5 mark. Then you times 250%, I give you 0.5 marks. Okay, so that's how I will work on it. You don't, if let's say you don't give me the workings, sometimes I wouldn't know where you've gone wrong. Okay, so at least if you have said something, I can still give you some points on your donation. Okay, so now I move on to carry forward. CA, U is for unutilized, UCA, unutilized CA, UL, unutilized loss, UD, unutilized donation. Sometimes you see people use the word unabsorbed. Okay, I mean interchangeable lah. Okay, so carry forward means that this year I claim CA, but I don't have enough income to set off, or I have a trade loss, or I have donations that I cannot set off my income. These are all unutilized in the current year. I can bring it forward, carry forward to deduct against my future assessable income. Okay. Conditions. Okay, there's no substantial change in shareholders and their shareholdings in relevant dates, meaning they have to what we call the shareholding test, more than 50%. Okay. For UCA, there's additional test that there's no change in the company's trade or business during the relevant dates, meaning they have to still be conducting the same business test. So just now remember, right? Just now I take an exam to do accelerated CA but in real life, you may not do accelerated CA if let's say there's a loss. Because if you think about it, if I claim accelerated 100%, let's say I have a lot of computers, those things that I can claim 100%, but I don't have that much income that I can claim. I carry forward, right? But then if I carry forward, if I want to claim deducted against future assessable income, I have to check. What if there's a change in my shareholding test? If there's a change more than 50%, then I cannot use the CA. So these are the other things that in real life we have to consider. For unutilized donations, there's additional rule. You can only claim up to 5 years. So for donations made in YA 2022, right? You can carry forward up to YA 2027. Any balance of that donations are not deducted will be disregarded, meaning to zero. Okay, let us look at the shareholding test on the relevant dates. Hey, thing here is that we have different dates for UCA, different dates for UL. Okay, relevant dates, we look at UCA first. It is the last day of the YA, which the CA arose, versus the last day of the YA, which the CA is utilized. Okay, so in this example, let's say the UCA, right? The CA actually arrived in YA 2015, is utilized in YA 2022. Okay, the last day of YA 2015, right? So YA is always ends on 31st December. It has got nothing to do with your accounting period. Okay, YA is always from 1st Jan to 31st December. So in this case, YA period, YA 2015, my last day of the YA is 31st December 2015. Okay, when am I going to use it? I'm going to use it in YA 2022. I look at the first day of my YA 2022, that'll be 1st Jan 2022. So these are two relevant dates. I look at the shareholding on these two dates. Is it more than 50% difference? Okay, but for UL, right? UL, in the year where the losses were incurred, right, we don't look at YA, we look at the year. Okay, sometimes it can be a bit confusing, but that's how the law is, too bad. Okay, look at last day of the year in which the losses was incurred. Okay, versus the first day of the YA in which the losses is utilized. The first day of YA, that one, no, it's the same one, regardless of whether it's UCA or UL. But in the losses, the year which losses have been incurred is a bit different. So in this case, example, UL for the year ended 31st December 2014 is utilized in YA 2022. Okay, so the dates that we look at, 31st December 2014 versus 1st Jan 2022. Okay, this is for info you won't be tested on this in that sense. But sometimes in your work, you may need to use it. So, so remember, if your shareholding, right, change is more than 50%, then you cannot use your unutilized UCA or UL. But you can actually request for a waiver of the shareholding test. Okay, this is where there's substantial change, right? The company sees that there's substantial change, but then they ask the controller to say, hey, can you waive off this test or not? Okay, and if the controller is satisfied that the substantial change in shareholder is not for deriving any tax benefit or obtaining any tax advantage, then they can waive off this test. Okay. This one you have to apply for it and then explain why it is not for tax benefit. State the circumstances why there's a change in shareholding, etc. So, okay, if you look at it, what they are trying to prevent is that I wouldn't want a case where company A, let's say, has a lot of losses, a lot of, let's say, UCA or UL. Then company B, which is a profitable company, of course, they have to look at various circumstances, but let's say they look at, I earn a lot of profit, I have to pay a lot of tax, right, for company B. I can buy over company A and then use their tax laws and UCA to reduce my tax payable for company B. Okay, that is one possible thing that can happen, which is what the controller is trying to block. Okay, these are for tax benefit. But for really real business situation where there's a change in shareholding, they buy over and things like that, real business sense one, then they can apply for this waiver of shareholding test. Okay, but if let's say application is made and then controller is not satisfied that there is no tax benefit and things like that, then the UCA, ULUD, they'll be disregarded. Okay. I think this is more for info. Okay, so for this UCA, UL, right, it can be carried forward. It can also be carried back. Okay, carry forward, there's no limit on how much you can carry forward. No limit on how many years you can carry forward. But it's just every time you carry forward, if you want to offset, you need to apply all those tests that we mentioned earlier. Okay, but for carry back, it's not auto. You need to make an election to say, I want to deduct against my assessable income of the immediate preceding YA. It cannot go back to many years. It must be just that year before. Okay, then once you make the election, you cannot say, I want to change later on. Okay, again, we apply the shareholding test, we apply the same business test. But then here, if you are carried back, right, there's a limit on how much you can carry back, just 100,000. And then also limit to either it's 100,000 or whatever chargeable income that you have. Let's say you only have 80,000, then you can only deduct 80,000. Actually, this is more to help smaller companies with their cash flow. So if then they can get some cash back for the tax that they paid previously. Okay, then we also apply all these rules. This carry forward, carry back is just for info in your ordinary work. Okay, so so for UCA, right, we'll look at what is the first day of the YA in which the capital allowance arose. Okay. Then the last day of the YA in which versus the last day of the YA in which the capital allowance is utilized. Okay, I think we look at examples, it'll be clearer. If the UCA, this is carry back, meaning current year I want to offset against my previous year's income. Okay, then here we are looking at YA, right? So again, YA is quite fixed one. YA 2021, I'm looking at 1st Jan to 31st December. That is fixed one. So first day of the YA in which capital allowance arose, this is always the more current one, right? So YA 2022, that's where my capital allowance arose, right? Then first day is 1st Jan 2022. Okay, then I'm back, right? I want to utilize back. I look at the last day of the YA in which the capital allowance is utilized. Okay, so preceding year, only for one back year. So YA 2021, my last day of the YA is 31st December 2021. It's just like 1 day difference. Okay. So when we are talking about YA, we're always looking at a calendar 1st Jan to 31st December. So when we talk about this year we are in calendar year 2023, right? So it's YA 2023, 1st Jan 2023 to 31st Jan 2023. So this is how that YA, this is how the YA works. This has got nothing to do with the basis period. Anyway, this is how the rules are set. So for the shareholding test for UL, again, UL, we have to look at not just the YA. Okay, I think we look at example. For UL, for year ended 31st December 2021, is utilized in YA 2021. Okay. So UL for year ending 31st December 2021 is YA 2022, right? YA 2022 utilized in year YA 2021, relevant dates. So what is the first day of the year in which the loss incurred? YA 2022, first day of the year which the loss incurred is 1st January 2021. Okay. Last day of the YA in which the losses is utilized. I'm going to use it in YA 2021. My last day of the YA, right? YA is 31st December 2021. Okay, so these are the 2 dates that I have to look at. Can be quite confusing, but anyway, you just apply the relevant, you just remember, like, that's all I can say. Just remember that this is how you apply. Okay, then you just plug in the date. Okay, so what about the tax adjustments that you need to make? Okay, for the tax adjustments that you need to make, if you can carry forward, so let's say example, so this year is YA 2023. If I have any unutilized CA, UCA, UL, UD, then when computing the tax com for YA 2023, I need to take them into account. So all these UCA, for example, it can be even from, let's say, from YA 2020. Let's say all these years I'm suffering a loss. This year I become a profitable position. I can utilize them provided that the rules are met. The shareholding test, business test, all these are met. Okay, carry back. Then, so meaning carry back, right? This year I have losses or UCA. Okay. When I allow the carry back amount, I need to less off this amount from my current year CA. So for example, let's say my current year CA is $100. Okay, I can carry back 20 because last year's profit is 20 so I let off 20. The amount that I can carry forward, I can carry forward is the remaining $80. So you need to remember to make these adjustments. Okay, so where conditions are not met, you have to disregard the amount. So this is what the UCA ULED is about. There's also a e-tax guide on this. If you want to, you can also take a look at it. Okay, now we'll look at group relief. Group relief also for your info only. So what we have been talking about, right, is actually everything is within the company. My UL, UCA from previous years going forward on within the company. Group relief is we look outside the company. We look outside the company. So they are related companies of the group. Okay. So if you meet the conditions, I can actually transfer my, let's say this year I have loss. I can transfer my loss to another company, another related company. Okay, so that it will actually help them reduce their tax payable. Then for me, the group, let's say the loss that I can carry forward will also be reduced. Okay. Then sorry, I see things coming in. Just give me a moment. For slide 181 diagram, should it be YA right side? Okay, so right side, right? Right side is the year where you incur the loss. I say it's for year ending 31st December 2021. So that's for YA 2022. Correct. So my loss is incurred in year YA 2022. So which is why this diagram shows YA 2022. Okay. Then move on. You have a bit to cover. Group relief. For group relief, for group relief, just I was saying that group relief is for those that are outside your company. Okay, so for those outside your company, you can also share the items like UCA, UL. Okay, so in this case, if I transfer my items to other related companies, you will need to reduce your current amount, your current year amount. Okay. Then, but if let's say I am a profitable company, okay, and then I I take in losses or UCA from other people, this will mean that I have more amount that I can less off from my taxable income. Okay, and then meaning that I pay lower tax. Okay, this is for your info only lah, because you need to meet certain requirements, which since it's not examiner topic, I won't go into detail. Okay, because we need to save some time for going through exam questions. Okay, so you just need to know that there's this group relief that you can make use of, and then there's this at least 75% that you need to look at. Need to apply test also, but this one I leave it to you to look at it lah, if it's applicable to you. There's also an e-tax guide on that. Okay. Okay, so supplementary slide just for info. Okay, now I move on to almost the end. Foreign tax credit. Okay, double taxation of foreign income, right? So just now we said that if a foreign source income is remitted to Singapore, we need to bring it to tax. But what can happen is that, you know, this income may already have been taxed overseas, right? And then now when it is remitted back in Singapore, it's being taxed again. So there is what we call double taxation. So depending, you may actually allow what we call foreign tax credit, FTC, to resident taxpayers, resident companies, against their Singapore tax payable. Okay, so this foreign tax credit, right, it can be a double taxation relief, which will be covered under the DTA part, or unilateral tax credit. Okay, it's given to those where DTA doesn't cover. Okay, but the condition is that this person has to be a tax resident in Singapore for the relevant basis year, and tax has to be paid on that same income in a foreign jurisdiction, and the income is subject to tax in Singapore. Okay, it's only when we bring it to tax, then we give a foreign tax credit. Anyway, this is also for info I can say. So in this case, right, what is the amount that we can allow is the lower of actual amount of foreign tax paid, or the amount that income, right, tax in Singapore would have to pay tax in Singapore on. Okay, I just give a numerical example, easier to understand. So this will mean that if let's say I paid, let's say it's some rental income overseas, now I remit back to Singapore. Okay, and then let's say the tax paid overseas is $100. Okay, the tax paid is $100, but for that, because maybe the tax rate overseas is very high, $100. But Singapore, let's say, has a lower tax rate, and then the person only needs to pay $80 in Singapore when we compute. So in this case, we will only allow the $80 instead of the full foreign tax paid. Okay, we only allow what is the amount that you will have, the income will be subject to tax in Singapore. If you think of it, it makes sense, because if not, I'll be subsidizing your foreign tax bill, which is not what Singapore wants to do. Okay, if the company is in a loss position, meaning there's no, if it's a loss position, then we would not give any foreign tax credit because there won't be any tax payable, right? Okay, then anyway, these are just for info last time we used to have a default method which we look at source by source, country by country. You need to I look at rental income from Australia, rental income from Malaysia. All these are source by source, country by country. Then what is your tax paid for the respective country? But later on, we have actually introduced what we call FTC pooling system, where you just add all your rental income or all your foreign source income together. You look at what is your foreign tax paid, then you just compare. But really depends. Sometimes it can cut both ways. So it pays for the company to work out whichever method is more beneficial to the company. Okay. So this is the formula used. This is actually a very general formula because actually sometimes it can be more complicated than this. But we just take a look at the formula. A is the gross income, gross taxable income of foreign income. B is the total taxable income from all sources. So basically here I'm trying to work out what is the amount of Singapore tax attributable to that foreign income. So because C, right, is your total Singapore tax payable, then it's like your foreign source income over your total income times your Singapore tax payable. That'll be what this foreign income Singapore tax will be on. But I think this is quite a simplified formula. There's also I think there's also an e-tax guide on this foreign tax credit source by source or pooling. So you can take a look at them if you need it for your work. Okay, so this is the end of the session of the slide. We still have some time. I think I'll just go through quickly on the exam portion. Okay, I think I'll just start from the end. Give me a minute. Slowly, but we're getting there. Okay, what I'll do now is just, where possible, I can let you know what are things that you don't have to, will not be tested. But it doesn't mean that whatever I didn't say will definitely be tested also. I need to leave the scope a bit wider. Okay. So TaxCom, you definitely need to know. Okay, for those who are not here last week, there'll be 2 questions in the exam. Question 1, short question and answer. You will need to know about taxability of income. You will need to know about deductibility of expenses. You may be asked to do some simple computation or maybe CA and some deductions. Question 2, okay, question 1 is 25 marks. Okay, so actually all the points items are like very short, small points given. If you tell me your taxability, taxable, not taxable, 0.5 marks, give me the reason for 5 marks. Then that's why I said you don't need to be very creative and write very long paragraph, just to the point. Okay. Generally, I can assure you most of the time we see not everybody can complete all the questions in the exam. So you need to manage your time. Both question 1, question 2, 25 marks. So total 15 marks out of 100 points. So I would say question 1, question 2 quite important. Okay, then everything you show your workings, most likely will award points for it, even though the final answer may not be correct. Okay, TaxCom, 1 whole question on TaxCom. Okay, maybe later on that I go through that TaxCom again. So anything that's in the supplementary slide not tested in the exam. Basis period, very basic, so you have to know. The paper you'll be given in the exam. Okay, so 17% tax rate. This exemption, you just apply depending on what is your final chargeable income, then you work out your sums accordingly. Exams will be on YA 2022, but sometimes depending on that tax comma will be on YA 2022, but sometimes for certain calculations, you also need to know how to compute for YA 2021. Like for example, your 14N, like your CA, all these they have your earlier years YA their implication. Okay, so income, you know what is taxable, what is not taxable generally, like I say, short question answer. Okay, so chargeable, but because it's taxable because it's in a course of business, revenue in nature, not taxable will be maybe capital in nature, things like that. Badges of trade, I won't have a whole question of badges of trade and then ask you to list all these, go through all these items, but just maybe generally know a bit. If there's any will be in those short questions, 0.5 marks, we also won't ask you, I don't expect a lot. Deductions, okay. So when someone is stressed, some things can happen one. Some I've seen before, people may say, when I ask about whether this income is taxable or not taxable, the person writes, this income is deductible or not deductible, then wrong, right? Income, we are looking at taxable, not taxable. Expenses, we are looking at deductible, not deductible. And this one is because of stress, just write wrongly, but wrong means wrong. But if you are able to give me the right reason, then I can still award mark. Okay, so all these expenses, you just know what are general rules. In exams, we just throw a lot of different types, then you just apply the relevant principles and relevant rules. Like I say, all this medical expense restriction definitely will be out in the tax comma, so you need to know how to work out medical expense restriction, show your workings. Specific provisions, we focus on 14N, 14B. Okay, I think last week you've gone through, took quite some time to go through this, so you need to know how to work out. All these examples here, you just remember so that you don't have to crack your head at the exams. Okay, so you need to work out. Like I say, sometimes if you need to compute 14N, even though it's for YA 2022, you need to know about, what you can deduct for YA 2021 or YA 2020, because there may be deductions that are carried forward. Okay, but like I say, if we ask for accelerated claim, you need to know, for example, for 14 for YA 2022, we can claim over 1 year.
Shani, can I just ask, just to clarify, the total qualifying R&R expenditure occurred is for the previous, that means, let's say if it's YA 22, is to calculate this expenditure cap, is YA 20, YA 21, and YA 22, is it? The 3 years.
Possible, yeah. So, for example, if I look at this example, YA 2022, although my YA 2022, the 120,000, I can accelerate, right? But for earlier ones, they are not accelerated. So it will still be brought forward some amount from earlier YA's expenditure. Like this 50,000 or 10,000, right? You still have to know so that you can arrive at the 180,000 figure for YA 2022. Okay, I hope this is clear. Okay, Z, I propose, you just remember all these examples here. Yeah. Foreign exchange also, remember revenue account, capital account, what are the tax treatment? Okay, and then what are the adjustments that you need to make? This one you also remember All things if you remember, then you don't need to recall easier in that sense. Specific prohibitions also, just remember all this. Okay, like I think sometimes like domestic, I won't say it's a domestic expense. For example, I may just come up with some example to show that it is domestic, then you know that this is domestic expense. So if it's under short question answer, then you can write not deductible because it's a domestic expense. But if it's, let's say, under the tax com, you don't need to give answer, you just add back. You don't need to give reason, you just add back. Okay, remember this one, 15,1K, always see people wrong because it could be still right for business, but still not deductible. Okay, so all this you just remember what is the tax treatment here. I know it's a lot, but yeah, but I scope whatever I can scope, but some you still need to know. So all these examples here already quite nicely for you, the commonly seen examples. Okay, supplementary slide. Part 2 CA, you definitely need to know, okay? But I won't tell you like what is prime, what is premise and things like that. So examples quoted will be common types. So you need to know whether you can claim CA or not. Okay, so your qualifying expenditure, not just on the original cost, you need to look at whether there's any other cost they need to take into account. But remember, interest is not deductible as CA. Okay, like I say, accelerated, for exam, we are looking at accelerated capital allowance. Then you have to look at the item, look at what can be claimed under the relevant section. Okay. Again, like, sometimes there may be some carry forward from previous YAs, so you need to know. Okay, there won't be any on HP, won't be tested on HP. Motor cars, you need to know. Okay, balancing adjustment, you also have to know. Section 24 election, don't need to know. Okay, this one you need to know like Singapore source approval, foreign source remitted, because definitely will be tested. Just now we've gone through like different types like interest, how do you bring them to tax, REITs, how you tax that. Foreign source income, this one don't need this one till you need to know. This one you just know basic stuff. Okay, all this donation definitely you need to know, need to add back, must add back, then allow deduction 2.5 times, show working. This carry forward, carry back one just for info. Group relief for info don't need. FTC don't need Okay. Now I will just go through the tax com very briefly, just to highlight the point. So you take out your question to case study. Okay, if you look at your P&L, like I say, some of things we'll put a lot of things around to confuse people So I would suggest that when you look at your P&L, you also at the same time look at the note behind. Okay, some of the items, they may appear description, they may appear behind the note. Then you need to know whether then is it a deductible expense, not deductible expense, or although they may say that it's an expense, but it could be a CA claim. Okay, then you need to add back because it's capital in nature. Okay, or sometimes if they say it's renovation, for example, maybe not everything is really renovation, can qualify under 14N, you need to make adjustments. Okay, so I would say it'll be good for you to go through the note also. Okay. Then yeah, show your workings. Like I say, everything you show for 5 marks. Okay, when you're writing description, it can be, if you look at the answer, you can be quite in point form like just now someone asked, right? interest from, let's say, Singapore FD, right? FD okay with me instead of fixed fee. Okay, dividend, you write DIV, I will also know lah. Dividend from, let's say, DBS Bank. Okay, but you don't, like, let's say there are two types of dividend, you don't just write dividend, then I don't know from from where, right? So, at least must be something for me that I can know what you're talking about. Easier for you, easier for me also, okay? Then, when you add back all this, okay, so net profit, add your less of your foreign source income, then you add your disallowable expenses again, like just now I said, right? Sometimes, I just for example, sometimes maybe entertainment expense, maybe in the notes, they give you a breakdown of different type of entertainment expense. You add back each point. Okay, you don't just add one amount, then maybe I don't understand how you derive at that amount. If I don't understand, then no marks. Even though maybe you need to add back, let's say three expense under entertainment, which can give you 1.5 marks. But give me one amount, I don't know how to derive at it, no points, okay? But if let's say you only manage to add back one expense, then at least you still get 0.5 marks. Okay, then so I mentioned, right, medical expense restriction, need to do working to, like this example, show you just work, show workings behind. Okay, then 14N need to show working. Okay, CA also need to show working. Okay, then it comes to add your other income, right? Those that exempt one, you don't need to even show here. Okay, whatever is in this tax form, case study is just for your study purpose, for your understanding. But if it's not taxable exempted, you don't even need to reflect in your tax form. You just need to add back those that are taxable. Okay, if let's say there are expenses related to that income source, then you will need to less expense. Okay, but this will mean that you also need to add the expense above, because it's not relating to trade. But you can still less off, let's say there's rental income. Okay, you need to after you declare, you add back rental income of how much, then you less off whatever deductible rental expense of how much to derive at the net rental income. For example, show working on your donations. Okay, then comes down to the last part, right? Partial tax exemption. You just show this working, you get 0.5 marks, 0.5 marks, all this already. But of course, you need to make sure that your calculation is correct, And then after that, then what is the tax payable? Okay, even though the tax payable is not correct, but still all this working above points. Okay, so medical expense restriction, I'm looking at the following page. Like I said, all these workings, you list them down so that even though your final figure is wrong, I can still give points on. Let's say you are able to identify salary and CPF, give you 0.5 marks. Okay, things like that. Same thing for a 14N deduction, list down the items, okay? Then if it's divided by 3, then okay, here no you're accelerated, you don't divide by 3. But at least I know whether how you show your workings. Yeah, so basically that's it. So any questions? Okay, like I said, you don't need to quote sections. This is for question 1, question 2. Don't need to quote sections. Okay, any other question? If you have, then on the exam, you raise it now, because to be fair to everyone, I need everyone to be on the same page on the exams. Any questions?
Shani, because in your example the case study, right, you put section 19 for some of those. So if in our tax com exam, if we don't put the section, then
Don't need.
just put allowance and then we put the number. But there are like two different ones, like less capital allowance. Then there's section 19A1, section 19.
Okay, so for example, in your workings, right, you have already, like, let's say computer divide, you don't divide, then certain things you divide. Then you add all your capital anything I already allow under the workings already. Then maybe you show the total figure in your tax form. So what can happen is that, for example, under your workings, you have, let's say there are, for example, 5 items that can qualify for CA, but you have only identified 3 items. Then I will give you the mark for the 3 items. So even though your total amount is wrong, it's still okay. But in your workings, I already seen your workings. So in this tax form example, it's more for your studying purpose. But in your tax form main form, you don't need to state the various sections.
Okay, thank you.
Any other questions?
Yeah, I have a question. Regarding the group relief, right? Just now I think you mentioned it's good for FYI, it's good for our day-to-day understanding of the taxation computation, but for the exam purposes, it will not be
Group
exam.
relief is not tested.
Okay. So unutilized CA and unutilized losses, right?
Also not tested.
Okay, great. Thanks a lot.
Any other questions? I cannot emphasize enough that these 2 questions makes up half of your exam question marks. I just want to emphasize this point. Any other questions? Like I say, some of it are like, hey, just give me enough. Don't need to write essays. All these are just short question and answer. Any other questions? Don't regret. If not, once we close, then that's it. Okay, then I think that's it. I think Jocelyn needs to
Yep.
put out something.
Okay. Thank you, Shadney. And to everyone in class, before you leave for the day, help us complete an evaluation form, which I will trigger right now. Okay, after you are done with the evaluation, you may leave the meeting room. Thank you, everyone. Have a good weekend.
Okay, thank you, everyone. I'll also be leaving the session. Thank you.